Thanks, Dave, for joining the quarterly webinar. As is our custom, we'll start with the U.S. economy. As we discussed after the third quarter, most of the experts got it wrong about the likelihood of a recession, just like the experts said inflation was transitory and that the U.S. stock market would be lower in 2023. But I digress, back to recession. As we look ahead to 2024 and consider whether or not we may see that long-awaited recession, what's your take on what transpired in 2023?
Well, thanks, Joe, and hello to our viewers. I'm once again pleased to share my thoughts on the U.S. and world economies and markets. And as you said, Joe, the experts clearly missed the mark with their forecasts on many levels. So this first chart shows the average predictions from 70 economists and strategists surveyed at the beginning of 2023 by the Wall Street Journal. These 70 experts represent a diverse set of institutions, including Wall Street, academia, think tanks, and nonprofits. They collectively believed that the U.S. economy would grow a meager 0.2% for the year and assigned a 60% probability of a recession in 2023. However, if the Atlanta Fed is correct, that inflation-adjusted growth in the fourth quarter was 2.2%, then the economy would have grown at 2.8% for the year. That would be right at the average for the last 50 years, which is quite remarkable given that population has steadily declined over the last 50 years.
So let's pause here a second, Dave. What do you think that the main reason was that the U.S. economic growth defied predictions, and where did all the market forecasters get it wrong?
Good questions, Joe. Last year, the experts felt that high mortgage rates and lackluster manufacturing activity would negatively affect the housing market, which is often a growth engine, and that layoffs in the manufacturing sector would put a dent in consumer spending. And as we've discussed in the past, consumers account for 70% of the U.S. economy. Now, according to the Bureau of Economic Analysis, which is a division of the U.S. Department of Commerce, the increase in consumer spending reflected increases in the purchase of both goods and services. Within goods, the leading contributors to the increase were recreational goods and vehicles, as well as other non-durable goods led by pharmaceutical products. Within services, the leading contributors were housing and utilities, food services and accommodations, and healthcare.
So then why do you think we didn't see a dramatic slowdown with 5.25% of rate hikes in 18 months, including the Fed selling a large holding of its securities? And wasn't there expectations that elevated levels of consumer spending were unsustainable, given that many headwinds consumers faced, including a depletion of COVID savings, an end to government stimulus, and expected resumptions of student loan payments?
Now, that's a two-parter, Joe. So first, regarding the dramatic increase in rates, those with a mortgage took advantage of low rates to refinance. And corporations also borrowed boatloads of money at low rates, with a significant amount of that debt not coming due until 2030. This debt restructuring made the broad economy less sensitive to the sharp rate hikes that wasn't immediately felt. As for consumer spending, according to the Conference Board, a global business-oriented think tank, consumers continue to fund spending with their dwindling pandemic savings, increasing levels of household debt. The Conference Board also cited the growth in these buy now, pay later plans. In fact, I've noticed my bank offers to split debit card purchases into 4 equal payments spread 2 weeks apart. And this practice has likely encouraged more consumer spending.
So thanks, Dave. Circling back to 2023 economic forecast, did the experts get anything right?
Well, they were reasonably close on their inflation forecast, predicting that the consumer price index would rise 3.1% for the year versus actual inflation that came in at 3.4%. But they were way off on the unemployment rate, predicting a final rate of 4.7 compared to December's 3.7% rate. Of course, we might expect a lower jobless rate, given that we avoided a recession last year. So forecasts for lower rates for both the bellwether 10-year U.S. Treasury and the Federal Reserve's overnight lending rate were both off the mark, again, because of unexpected strength in the U.S. economy.
So now that 2023 is behind us, let's look ahead to 2024 and both the outlook for growth and inflation. We're both fans of Dr. David Kelly, who's the chief global strategist for JP Morgan. He's known for the Guide to the Markets, which is often a source of charts we use with clients. In his first webinar of 2024, he offered predictions using each digit in the year 2024. He felt that the U.S. economy would grow 2%, it would experience 0 recessions, inflation would end the year at 2%, and unemployment would remain at 4%. Do you agree with Dr. David Kelly's forecast, Dave?
So while I do have a lot of respect for David Kelly, I think he may be a bit optimistic. And I should note that his boss, Jamie Dimon, warned in JP Morgan's most recent earnings call that he thought inflation would be stickier and that rates could be higher than investors expect. Dimon also opined that the expected soft landing is at risk as growth is being fueled by these large amounts of government stimulus spending and other past stimulus. But let's look at what the experts are now saying. In terms of GDP, the economists expect 1% growth for 2024. They collectively also pegged the probability of recession at 39%.
So then why are you more closely aligned with the Wall Street Journal's panel forecasts of just 1% growth?
So for the aforementioned reasons, curtailment of government stimulus, depletion of savings, resumption of student loan payments, and bills coming due. While I do worry a bit about the potential for a recession, I do agree that rates will likely fall throughout the year. Falling rates are positive, especially for the dormant housing market, as well as for strengthening business investment. In addition, business conditions continue to deteriorate. On this next slide, the left chart shows the path of the Conference Board's leading economic index. It shows the current conditions are approaching a level last seen at the onset of the pandemic. The right chart shows that small business owners continue to communicate level of optimism regarding future economic trends. The economy is facing some headwinds that may be difficult to overcome. Now, of course, these are near-term concerns. However, we at Wespath maintain our optimistic outlook for moderate but sustainable economic growth for the longer term.
So Dave, what about inflation? Do you think that we're going to reach the Fed's 2% target by the end of the year? And I'll note that the latest reading ticked higher to 3.4%, with core coming in at 3.9%.
We're clearly headed in the right direction, Joe. In the past, I've talked about the extent to which housing costs have been significantly responsible for keeping overall inflation rates higher. This next chart shows the recent path of inflation for the 3 largest components of the Consumer Price Index. Shelter costs have continued their steady decline from their 8.2% peak. That said, I wanted to show this next chart from Realtor.com. Viewers should focus on the black line on the left y-axis, which represents the annual percentage increase in rents for 2-bedroom apartments. While we saw a huge spike in rents on the heels of the pandemic, annual rental rates have been declining over the past 8 months or so. What's more, a substantial number of completed housing projects will hit the market this year, placing further pressure on rents. Hence, we should continue to see decline in shelter costs, which increases the chances of reaching the Fed's 2% target sooner rather than later.
And what about employment, Dave? Do you align more with Dr. Kelly's predictions that the rate will remain below 4%, or do you think the consensus forecast of 4.3 will be more realistic?
So, given my reservations that the economy will grow at 2%, then it seems that the unemployment rate will likely rise. I clipped headlines on this next chart from news reports that came out just over the last couple of weeks. And while it's true that layoff announcements occur more often in January than any other month, Any scaling back in consumer spending will likely result in accelerated job cutbacks.
So before we move on to talk about international conditions, is there anything else you'd like to cover regarding the U.S.?
Sure, Joe. While my near-term outlook may not be very rosy, conditions for corporate profitability continue to improve. Earnings growth in the third quarter of 7.5% far exceeded analyst expectations, as we can see in the chart on the left-hand side. On the right side, we see that while analysts expect earnings to grow at a lower rate in the fourth quarter, forecasts for 2024 and beyond are quite optimistic. And that's a reassuring sign as we head further into the new year.
Great, thanks for that, Dave. Let's now talk about international. So investor interest in the long dormant Japanese economy and its stock market seem to have been revived. It's been quite some time since investors have had positive things to say about investing in Japan. So what can you tell us about the world's third largest economies and the reasons why it's now drawing more investor interest?
So I agree, Joe. There's been a lot of chatter recently about Japan. In past webinars, we've talked about Europe, the UK, the emerging markets, and especially China. But I cannot recall a conversation that you and I have had about Japan. So it's good time for us to catch up on the news there.
So how has the Japanese stock market performed as of late?
So the Nikkei 225 stock index gained 28% last year, slightly exceeding the S&P 500's 26% return, though that 28% gain was in Japanese yen, which depreciated about 7% relative to the US dollar. So on a dollar basis, the S&P 500 did better. Now, from what I've read, there are two main reasons why investors have turned bullish on Japan. First, the Tokyo Stock Exchange recently launched policy initiatives promoting better corporate governance with a focus on optimizing how companies finance their business operations. In addition, regulators have placed greater scrutiny on potential conflicts of interests between companies and their independent subsidiaries. A second reason is a return of inflation to the Japanese economy. When an economy is experiencing deflation, consumers defer spending in anticipation of lower prices. In addition, Japan's negative interest rate policy discourage investment or even depositing cash in banks. The return of inflation changes this dynamic. So this next chart, Joe, shows two periods of strong performance of the Japanese stock market. The chart on the left shows the performance during the 1980s when the market skyrocketed. The right chart shows performance over the past 10 years. Certainly, it's not as dramatic as the climb in the 80s, but it is a steady climb. Now, alert observers may notice that even after the Nikkei's rise over the last 10 years, it hasn't yet reached its 1989 lofty level. And indeed, if we look at the entire history since 1980, we can see that someone who invested in the Japanese market back in 1989 remains underwater. It's been over 30 years since that peak, so many investors may consider those to be lost decades for the Japanese market.
So that last chart, Dave, explains why investors have pretty much ignored Japan until recently. Do you have any thoughts on how much longer this Japanese renaissance may last?
Yeah, Joe, I really haven't a clue. The Japanese economy is unique relative to other world economies. It is one of the most rapidly aging societies in the world and must rely on immigration if it wants to grow its economy. Whether its society will be more welcoming to immigrants and whether it continues to make meaningful governance changes remains to be seen. So I have one more slide, Joe, that I put together based on a comment you had made recently at one of our team meetings. At the end of 1989, 6 of the 10 largest companies on a market capitalization basis were Japanese companies. So Joe, if we were to rank today all the world's stocks by market value, where do you think the highest Japanese company would rank today?
Yeah, we've talked about this as a team. Toyota's the biggest company, but I don't know where it would rank.
Great guess, Joe. It is Toyota, and it's 50th place, with 42 U.S. companies having a higher market value than Toyota.
So that's quite a difference relative to, say, 35 years ago. So before we wrap up, is there anything else you want to mention to our viewers?
Yeah, one last item, Joe, and it's somewhat related to the rise and fall of the Japanese companies we just discussed. Earlier, Frank and Johara talked about the Magnificent Seven in market concentration. This next slide shows the 2023 total return for those 7 stocks and the extent to which the top 10 stocks comprise the S&P 500, which at 32% is now at a historically high level. And this next chart is another one that you posted on our Teams channel recently, which I thought put into perspective just how large of a valuation these 7 companies carry. The market value of all 7 companies exceeds the total value of the companies from Japan, China, France, and the United Kingdom combined.
So agreed, Dave. Although I've also posted an interesting analysis from the Man Group that makes the case why the valuations for these companies may not be that unrealistic, but we'll need to save that debate for another day.
I look forward to that debate, Joe.
So Dave, thank you, and thanks to our viewers. If you have any questions, what you heard today or any others, please do send them along.